Yeah, exactly. Well, while we're on the topic of ETFs, and specifically while we're on the topic of knowing yourself as an investor, let's get into some talk about ARK Invest because I own a few ARK funds. I know you don't own ARK funds. However, I want to talk about this, and I think we're actually going to have a lot more agreement than disagreement on this. So, just kind of give your 2 cents on ARK, and I know you made a video on this, but I'll just kind of let you go first.
Yeah, and first of all, I don't want to come off that I'm against ARK. I know sometimes I come off that way. Absolutely not. If you have your convictions, my opinion shouldn't matter to you. And I know you're that kind of investor where it won't. So I'm not talking to you, but there's a lot of people when I was looking and doing research into ARK funds that the inflows started coming in after the crash in March 2020. And that's really where the outperformance started. And a lot of people just kind of jumped on the hype wagon. But then when I zoomed out and I looked at what other funds have done this, I found many funds that have done this over many different decades. And it goes back to the idea that we put so much trust into a fund manager to predict the future, and they can't do it consistently. They can do it 5, 7. Peter Lynch did it for 13 years. But they can't do it past that. Eventually, that fund manager will retire. They're going to go start their own fund. They're going to do something else. We've already seen a little bit of a battle with Cathie Wood and whoever the management company was. I think they square that away now. But she's old. She's going to retire. She can't be Cathie Wood forever. Eventually, she's going to retire, and eventually, this outperformance has to end. So, as a long-term buy and hold investment, I just can't see, not just ARK, but I can't see any active management. How can you buy and hold it when you don't know what the future is of that fund? And then the second point is with disruptive technologies. I'm a huge believer in disruptive technologies, as we've talked before. But the fact is, I recently saw an interview where she said that index funds don't or can't have these disruptive technology companies that she has in her funds. And I think that's so far out there, and it's stretching it because yes, she can pick disruptive funds, but the index eventually will have the ones that grow or they're the biggest. So for example, if you just look at the S&P 500 and you look at the top 10, you see a lot of Google, you see Tesla, you see Amazon, you see all these companies that 20 years ago didn't really exist. So the index funds always picks the winners, and it makes them a heavy weight in the portfolio, where there was plenty of companies like pets.com that didn't make it, unfortunately, or I don't know how many social media competitors there was to Facebook, but they didn't make it. So the index fund doesn't try to guess what the winners will be. It just ends up, because it's a market cap weighted index, it just ends up holding more and more shares of the winners, and the losers either don't make it in the index. If it's an S&P or if it's a total market, they have such a small weighting that when they do eventually fail, they have no weight to what the performance of the index is. And because Cathie Wood has only about 30 or 40 holdings, and they're all sort of, in my opinion, disruptive technologies, people try to tell me, well, they're in different industries. They're in the tech industry. We've seen what happens when bond yields start to rise, how tech is affected. We've seen other previous crashes where tech bubbles form, tech bubbles burst, and then tech goes to underperform, I don't know, 15, 20 years until it becomes relevant again, like it is now. So I just caution people that people think that history doesn't repeat itself, but we've seen this many times over and over again with fund managers, with disruptive funds, whether it was in technology or whether it was in different fields, and they always end up the same. They always end up flat on their face, and they usually close or go out of business within 10 or 15 years since they're from when their hot streak began.
Yeah, it's funny you bring up Cathie Wood's age because you wouldn't think that she's as old as she is, and she's not incredibly old, but I think she's in her late 60s or something like that.
Yeah, I
So
think
it's
she's 52 or something like that, if I remember correctly.
okay. So, at some point she's going to want to be done with this. It's like she's not going to want to do this forever.
She's been in the investment industry since 1972.
Yeah.
And my whole thing is, where was she since 1972? Nobody's ever talked about her. She's been in the investment industry, and I hate to say it, but she got lucky with this disruptive stuff. Yeah, she had a great, crazy bull thesis on Tesla that I loved, and I don't love anymore, but I loved. And she, part of it was skill, yes, but most of it was luck. And if she is as good as people say she is, where was she since 1972? It was really, she was running a lot of technology funds even back in the internet bubble, but nothing came of it until now.
Yeah, there's not a whole lot. I've done research on it as well. I mean, I've just been kind of able to catch where she worked here and there, but she didn't really come onto the scene until this past few years. So it'd be interesting to do a little bit more of a deeper dive on that. But I think the biggest thing to take away here, and I know it's something you've talked about before, I think it was with the Magellan Fund where they outperformed the market every year for 10 plus years or something, 13 years. But something like over 80% of people invested in their fund lost money.
Yeah.
And the way I think about this with ARK is, let's say they did 100 times return in 2020. I don't know the exact for each individual ETF, but
127 for ARKK.
ARKK, cool. Let's call it 100 just to make it easy. So 100% return in 2020. They could have a 0% return for the next 4 years, and they'd still be averaging a 20% return over a 5-year span. So unless you caught it at the bottom, right, and you're expecting to outperform the market like a 20% return, you're probably not going to be there exactly on time. So if you have the wherewithal, like we talked about previously, it's something you believe in and you can buy when you see it drop 5, 10, 15, 30% so far this year, knowing that you're going to hold this for 5 to 10 years, then it's a completely different story. And my kind of story with ARK is it was about this time last year where I started to hear about them. I'm sure the first reason I bought, I'm in 2 of their ETFs. I'm sure the first reason I bought was just because you hear the hype, right? Yeah. All you're hearing is hype. And luckily, I probably did catch what was close to the bottom based off of where they are today. Now, I didn't invest a ton at that time, and I've been kind of dollar cost averaging as we go. And as I kind of did more and more research, it did build my conviction on, where I could see these things. But it's funny that I'm happy we're having this conversation now, because the exact things that you're saying in terms of the issues with actively managed ETFs versus, whether it's a broad-based or even just a NASDAQ tracking ETF, is the things that I've started to think about more and more now. And of course, as you can imagine, with those type of returns, my ARK holdings have gotten a little bit out of whack in terms of weighting, even with the 30% pullback. So my focus over the past few months and going forward is to try and balance this out by investing into whether it's QQQ or something a little bit similar to that to kind of get rebalanced. So I'm probably a little bit more of a believer in what I think ARK can do, but I 100% agree with almost everything that you're saying. So I can kind of see both sides of it.
Absolutely. Yeah. I mean, again, you are the kind of investor that I think is very rare out there when it comes to ARK funds. You did get it at a perfect time. And even if you've been dollar cost averaging up, your average cost is probably still a lot lower than where it's at now. Cause I think it was at like 30 or 40 bucks back in March or whatever it was. Again, yeah, that statistic is with the Magellan Fund is real, that 80% of the investors actually returned a negative return by owning that fund. And the reason is it wasn't even an ETF, it was a mutual fund, but they were still trying to time it. And it goes back to timing. We're terrible at timing stuff. Sometimes a 0.5% correction might make us feel a certain way, and we sell out when on the upside, there's like 20% to be gained. So absolutely, there is still a thesis that you can put out for ARK Invest, and to say that long-term, it could be a buy and hold if you bought it at a good enough price. What I'm seeing on my channel and the people that I'm talking to, they're paying 140, 150 a share, and they saw my video and then they're saying, well, it's going to go to 200. And now it's at I don't know where it's at.
112, 113 today, something like that.
Yeah. So now it's at that, and I'm kind of pushing their buttons and I'm saying, oh, look at it now, to see if they're really, if their conviction is in ARK, or if they're just hype people that jump from one thing to the next thing. And a lot of people I'm finding are either, selling out of it at this price after paying 150, which blows my mind. If you liked it 2 months ago, why don't you like it now? Like, nothing has changed. My opinion shouldn't.
Everything's gone down. So
exactly. And to mention that, technology and QQQ and the NASDAQ, I mean, they've been hit just as hard. I mean, Apple, Tesla, all these big tech stocks have been hit hard.